You're watching episode 45 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall. Before we get started, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Additionally, check out our new premium membership site. You'll get access to exclusive content and a weekly tax strategy newsletter. You can check that out at www.taxsmartinvestors.com. Today's topic is about capital gains coming from the sale of a rental property and whether or not those are considered passive capital gains that can be used to offset other passive losses, or I should say it in another way, can the passive losses from my rentals that I'm holding on to offset the passive gain coming from the sale of a rental that I've just liquidated? The answer is yes. So if I have passive losses from one passive activity, and frankly, it doesn't even have to be rentals, it's just a passive activity. You either have passive activities or you have non-passive activities. Everything that's in the passive bucket can net out against each other. So if I have losses from one passive activity and then I have gain from the sale of another passive activity, the losses from, let's call it passive activity B, can offset the gain on sale of passive activity A. Now, CPAs get really confused by this. They say, hey, you can't go and invest in a syndication and create passive losses to then offset the gain on sale from a rental activity, or one rental's losses don't offset the gain on sale from another rental, and that's not true. What I always challenge people to do in this type of situation is to ask your CPA to prepare a pro forma tax return. What that means is you're basically making a projection. Everybody can do this in their software if they're paying for, especially like the higher end software, you can pay a little bit of an extension, a little bit of a fee to get this extension software that can run these projections. But your CPA should be able to prepare a pro forma tax return to show you a what if scenario. So if I sell this property, what happens? And if they really look at it, Form 8582, which is like the top tax form that every landlord should know about, Form 8582. If you go through Form 8582 and if you read the instructions, it very clearly says that when you're selling a passive activity, you report it on Form 4797, which is where you report the sale of assets, but then it flows to Form 8582. And when it flows to Form 8582, the gain is going to be reported on Form 8582. Well, Form 8582 is where you report the income or losses from passive activities. So if the gain on sale reported on Form 4797 is going to flow in to Form 8582, then on Form 8582, we're also going to be reporting our passive losses from all of our other passive activities. And if you look at line 4, on Form 8582, you'll see that they all net together. So passive losses from one activity can definitely offset the passive income or passive gain from another activity. And if your CPA says that's not true, ask them to prepare a pro forma tax return, a what if scenario, and they might be surprised. I hope you enjoyed today's Tax Smart video. Check out all the links that we have below to follow us online. Join that Facebook group. And if you have any questions or if anything that I say resonated with you, drop me a comment below. I love engaging with the community and really appreciate those of you that take an extra 10 to 30 seconds out of your day to drop me a note.